Welcome to Franchise Empires, where aspiring entrepreneurs learn exactly what it takes to become a successful franchise owner, from one location to 10 and beyond. I'm the Wolf of Franchises.
Hey everyone, it's the Wolf. Today's episode is a new format. It's an Ask Me Anything format, meaning I take in questions from you guys, the listeners, follows me on social media, and I just answer them. So in this episode, I'm going to answer, 5 to 7 questions that people ask me on Twitter from, how would I pick an emerging franchise today to when is a franchise a viable investment, and a bunch of other questions. I just basically riff off the top of my head based on the questions, so you guys get the real raw responses from me. These aren't, carefully planned and answered in advance. I want you guys just to hear how I really feel about these things. So we're going to be doing this once a month. And if you ever want to submit your own question, you can DM me on Twitter. You can look out for tweets where I ask you all to leave your questions in the replies. Or you can also reach out to me on LinkedIn or my website, wolfoffranchises.com, where you can submit a form to contact me. So thanks for listening, and let me know what you guys think of this new format.
The Wolf of Franchises is the CEO of Wolfpack Franchising, as well as a creator at Workweek Media. All opinions expressed by the Wolf and podcast guests are solely their own opinions and do not reflect the opinion of Wolfpack Franchising or Workweek. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The Wolf, Workweek, and Wolfpack Franchising may maintain positions in the franchises discussed on this podcast.
All right, Wolfpack, I'm excited for this. Let's just dive right into the questions. So first one from Paul Tran, a former guest on the podcast, actually. He asked, if you're interested in buying an emerging brand, what kind of things do you look for to better your chances of success and enjoying the ride up? Great question. Right off the bat, I definitely wrote a newsletter about this, and I'll dig that up as I kind of respond here. But I went pretty deep into my criteria for evaluating an emerging franchise. So I would definitely read that if I was you guys, and I can link to that in the show notes for you to dive into it. But overall, look, there's some criteria that everyone should be looking for. The biggest thing is return on investment potential, which your best ways of understanding that are using the FDD, and hopefully they have some performance representations in there. If not, it could be a red flag, especially if it's an emerging brand. To me, that's a red flag. I have yet to find a good reason why someone wouldn't actually include their financial data in there, other than that it isn't that impressive. It's a hot take in the industry, but it shouldn't be. It's true. If you're in the industry, you probably know it. You just don't want to say it. And then beyond that, you can also talk to franchisees, of course. So some bigger brands, right, don't have performance representations in their FDD. But again, Paul's question was referring to specifically emerging brands. So, there's a few other things, and I just found the newsletter. It's from, and you can access this on my website if you don't want to check the show notes, at wolfoffranchises.com. Go to the newsletter section on the navigation bar up top. And all my newsletters are in chronological order from most recent to the oldest. So you can just scroll down to the September 25th, 2023 edition and read this. But beyond the return on investment potential, replicable operations is super important. You want a brand that can scale and teach you how to run that business over and over again. Not just you, though, your other franchisees. If the brand's going to scale, it's got to be a simple enough concept. The supply chain has to scale as well. And then you want to make sure there's some value to the brand, and even if it's not at the stage it is today, right? Because, every franchise, including McDonald's, started with one location, which means the large majority of the country doesn't know about a brand for a while. But if you can see that brand evolving into something real, and the executive team too, if you can see them, if they're not necessarily C-suite leaders, which they're probably not, they're bootstrap franchisor founders, they don't have to be, can they evolve into leading this brand into regional, national, potentially international brand, as well as support you and, be good business coaches to you. The last thing I'll just say on this question, because there's a lot here, is, try to understand how well capitalized the franchise brand is. I give a lot of credit to any entrepreneur. It's very tough to build a business. The thing with franchising is it's a big responsibility if you're going to franchise a brand, because you're saying, hey, I have a business and it is so good that it's worth other people investing hundreds of thousands, if not millions of dollars to, basically license our brand, and we'll teach them how to run the business. and so on. But a lot of these brands aren't aware of how expensive it is, right? I think there's this misconception that you could just sell franchises and you're going to get rich off the franchise fees. But then they get into the game and realize that they're probably only going to find franchisees via franchise brokers. And that's because most people don't, really have an audience or any other effective or profitable way to market to find new franchise operators. And then all the franchise fee revenue is going out the door to brokers for the most part. When I say all, I mean probably anywhere from 50 to 80%. That's if they're using a franchise sales organization on top of it. If not, just 40 to 75% typically is what brokers take, though there are some who take 90%. Either way, it's a huge dent in your franchise fee commission and revenue. And you don't have much to invest into the actual franchisees and hire support staff and training staff and scale up marketing across your franchisee base and pay for technology tools like Crockett or other franchise specific softwares that actually provide value to you as a franchisor and your franchisee network. So if your franchisor doesn't have on their balance sheet, which you can check that in the financial statements in the exhibits of the FDD, they're required to share their, full financial statements there. You got to understand really what are they actually going to be able to invest and support you with. And you're the one taking the risk. So it's well within your rights to have that conversation. So that was a long response. I'll try to be a bit quicker with some of the next ones, but that was a big question. So I wanted to cover as much as I could. Next one, Joseph Durfee. What franchise category outside of home services are you most bullish on for the next decade? For one, my gut reaction is a decade is a long time to be bullish on something. Things change pretty quickly, right? Over a 10-year period. Home services, he's right to exclude that because they're never going out of style. Even though I think there's a lot of home service franchises and a lot of people are thinking it's going to be easy money. I would disagree with that. I think, food and beverage is the biggest category in franchising, restaurants, that is. I'm sure there will be some new winners over the next 10 years that aren't known today or don't even exist yet. Health and wellness, it's a bit trendy with, saunas and, med spas are popping up. I think there'll probably be a few winners from that long term, but it could become oversaturated. Yeah, honestly, my take on this, and, when I look back to the newsletter I wrote, I think it was the top 5 franchises of 2023. That was my last newsletter of 2023. I had 2 home service brands. I had Rolling Suds, a power washing franchise, and then a residential cleaning franchise called Home Clean Heroes on the list. I had Funbox, a recreation/event franchise, where you build a bounce house and you basically have like a little pop-up festival for a day on the weekends, and it drives pretty impressive numbers. Then I had Milkshake Factory, and then I had Uptown Cheapskate. So Milkshake Factory, as you would guess, it's an ice cream restaurant, effectively. And then Uptown Cheapskate is a used clothing store, and they were the number 1 concept on my list. So what that tells you is we have a restaurant, we have a retail clothing store, we have home services, and then we have recreational, it's called. So all over the map for concepts. And I would say I'm less focused on specific industries per se and more focused on individual concepts. I don't think the industry approach works well for franchises. In general, it's if you're going to buy an emerging one, especially, right? The winners, there's usually only a few winners of each category. And I mean like serious winners, right? And, if we look at boutique fitness, you have Orange Theory, who's done well for a long time, even though they're probably going through some consolidation right now. And then you have a lot of other niche small brands that, franchisees haven't done well in. So yeah, great question, but I tend to just pick out individual concepts that I think show really impressive unit economics, have a good team, can grow or are growing. And, it doesn't matter what the industry is because, franchises are at the end of the day, typically just a small business that they're able to scale by training other people to deliver that same service in their market. So yeah, that's my thoughts there. Moving on, this person says, I was both franchisee and franchisor. At what point does a franchise restaurant become a viable investment? 12 units, 50 units, multiple states. When does the royalty or marketing percentage really pay off? So I think that's not something that, I guess a different way to say this is, it really depends on your risk appetite for that first part. When does it become viable? And it also depends on some of that criteria I mentioned earlier from Paul's question, right? Are they scoring 10 out of 10 on every criteria for an emerging brand? because then maybe that brand is actually a viable investment at 5 or 10 locations or 2 locations even, who knows? I mean, there's always going to be some risk regardless, but I think it really depends on someone's risk appetite. Personally, if I saw 50 locations open and the economics from these 50 locations were good and the franchisor team was solid and all that stuff, return on investment was there, that's more than enough proof of concept for me, because that's really what we're talking about is, when is there enough proof of concept? For some people, it might not be 100 or 200 or 300. I'm probably higher up on the risk appetite scale. So yeah, you just got to know where you fall there. But, generally if it's, and I guess the last thing I'd say is the longevity of the investment, right? I've talked a bit about recently these brands that have 3 to 5 locations with crazy unit economics, and then they're selling 500 plus locations off the back of that. And who knows though, how long are those economics going to hold up, right? So that's what you have to think about too. And then for the royalty or marketing percentage, when does that really pay off? Look, I've always thought about it of a franchisor can charge you whatever they want for the royalty as long as you're making profits, and it's fine, right? If a franchisee is getting charged somehow, let's pretend there's a hypothetical brand out there that's charging a 50% royalty and you're still making your money back in 2 to 3 years as a franchisee, and then the rest is pure profit. That's phenomenal for you. So yes, a franchise brand in that ridiculous scenario could charge 50% of the profits. And actually, as I'm saying that, I mean, I'm kind of like dancing around Chick-fil-A's model, which obviously there's a lot of differences there. But the point is I always just think of it as what is the cost to build and operate a location, and how much money can I make when all is said and done after the royalty, after the marketing percentage. And if you're able to make, my target is like brands that at least show the potential to earn your money back in 3 years. If you're able to do that, then it doesn't really matter like when, quote unquote, the royalty or the marketing percentage pays off. If the franchise brand is helping you build a really successful business, then that's all that matters at the end of the day. Next question. Are franchises relevant in the age of information? Does a brand really carry the weight it once did? Yes, absolutely. I mean, these are small businesses and brick and mortar and service businesses. Those aren't going obsolete all of a sudden. So, and does a brand really carry the weight it once did? Absolutely. I'm a firm believer in brands are never going away, whether you like it or not. People are buying Teslas because they want to say that they're a Tesla owner, right? That's the brand speaking. Someone drinks Sam Adams over Heineken because it's part of their identity. One brand aligns with their identity, and that's part of their personal narrative. And so brand will always matter, whether it's in consumer products, where you shop, which gym you go to, and so on. And so, franchises that are consumer retail focused, I think it really matters, or it can matter, and it can be a huge differentiator. So I don't think it's going away in the age of information. Not sure if there was more behind that question, but that's my quick take. Next question from TB. How do you think about non-physical franchise concepts? How are territories adequately defined / protected? So great question. For non-physical franchise concepts, the way they break down the territory is incredibly important for you to understand during your due diligence process. And you can get a sense of that in item 5 of the FDD. So look, it's going to vary from brand to brand. But, I was just speaking with someone about home services franchises that, I think there's 2 fencing brands. One of them is much more developed. And he was telling me that, he bought one territory and that territory included a population of 400,000 people. That's how the brand was defining it, a territory. And then this new fencing brand was breaking up, quote unquote, territories into population groups of 100,000 each. So for that second brand, 4 territories is the equivalent to 1 territory for the first brand I was discussing. And so that second brand, you're going to have to pay 4 franchise fees to secure the same amount of population to build your business in. So again, like the numbers got to be pretty good for you to justify 4 franchise fees just for that level of population. And also ideally, right, I mean, you have some baseline of comparison in the item 19 of the FTD where the corporate territory they're showing, they also disclose, what level of population that business is generally servicing. So that way you can know, okay, the corporate unit has been around for X number of years. Maybe it's the equivalent of 2 to 3 territories, and aka 2 to 3 franchise fees. And, I've talked a little bit about broker dynamics and franchise sales organization dynamics, but your average franchise fee, to me, it looks to be going up. there's new brands popping up that are doing $60,000 franchise fees. And then there's some like more legacy brands that are still charging the $20,000 to $25,000 franchise fee that used to be the norm. And I think that's $60,000. I mean, right, when you're looking at how the territories are broken up, that's a big chunk of cash for most individuals to, if they want to secure the market that they want to build a business where they can really change their life financially. And it's a bigger upfront investment to secure that territory if you have to all of a sudden, do 60,000 times 4 instead of just 1 franchise fee. So definitely, look into that. And again, it's all about your overall return on investment factored into this. Look, if a brand is being it's expensive from a franchise fee territory perspective, but the numbers will still, they appear to be great for you after that hurdle, it can still absolutely be worth it. But again, it does make it tougher for the individual. How can someone start/open a franchise today in the QSR space? It's a high initial investment with very high rates. I'm assuming he means interest rates there. And payout usually ends up being around 7 to 10 years with today's high labor costs. Thanks in advance. That's from Novice Trader. Thanks for the question. Great question. So yeah, it is hard out there right now. I wrote a newsletter recently to start the year. How would people get started today? And this was from current successful franchisees. And one of them basically specifically said, he's like, I would avoid brick and mortar. I would go only, into home services or just non-brick and mortar because, cost of capital is up, right? Interest rates are a lot higher. So if you get a loan from an SBA loan, the interest rates are going to be a lot higher today than they were in the last, 5 to 10 years. The cost of construction is also considerably higher. Rents are going up. Labor costs are going up in restaurants, especially, right? So yeah, it's never been more difficult to start a restaurant. And, it's going to be interesting over the next 2 to 5 years. You have a lot of brands and locations that might have to up their rent price quite a bit because the landlords are forcing them to pay that. And you're going to see, more menu inflation most likely from that. That's the result. I mean, there's only so much that restaurant owners can do. Now, unfortunately, they have to pass on some of these costs to the customers. That's just the way it goes. So yeah, I think there's still good opportunities out there. It's very difficult to sift through them. I would frankly find a franchise consultant you could trust, which I'm happy to recommend some. Just DM me on Twitter or pay for a subscription like Crockett where, you can filter and sort through 2,500 plus franchises today. But I think smaller square footprint, right? Super, like takeout type places, anything with big square footage and, there is dine in, you got to be careful about. Not to say that I'm not saying that category is dead and gone. I'm just saying you have to be very careful about a concept like that. But yeah, I think the smaller square footage concepts, with quick to go takeout ordering would be, and low on labor, obviously, right? Those are your safest bets to try to mitigate your expenses, which again, it's just a tough battle right now for restaurant owners. Last question, Kelly Foster, which specific franchise sees the highest failure rate? If you can't get that granular, how about by industry? So I can get that granular, I guess. I mean, look, the biggest brands typically are the ones that are closing the most locations, right? So like just right off the bat, I mean, Subway, I believe, is number 1 over the last 3 years. They've closed close to 5,000 locations. They're now owned by Roar Capital, thank God, because, it was really a tumultuous history with that brand in the prior ownership group. But yeah, I mean, Subway, again, they've closed 5,000 locations and they still have, 20-ish thousand locations open in America and more worldwide. But that 5,000 locations that they've closed in the US, I mean, that's more than, that number of locations more than most brands have by a large margin. So I don't know if there's emerging brands that are closing. I know some places like Massage Envy have closed like 100 locations or so in the last few years. I'm thinking off the top of my head here. I mean, Quiznos is still going downhill. Blimpie is still going downhill. Even I remember Denny's talk about dine-in options, right? They've closed about 115 locations over the last few years. Golden Corral as well. So there's kind of this like legacy casual dining and some fast food, right? Some legacy fast food like such as Golden Corral that they are closing locations. And so, but even some places like Jimmy John's have closed about 150 stores. Burger King is also closing stores, like 300 stores over the last few years. And now I'm reading data off of our back-end data system in Crockett, just so you guys know. But then I also see F45 has closed a couple hundred locations as well. Same as Supercuts, 422 locations they've closed. So yeah, look, there's a lot of brands that are always going through these ups and downs. That's the bottom line. And that's why you want to check, again, item 20 in the FTDs, where you can get all this information about any brand that you're looking at. So, not just that first chart, dive into the deeper charts 3, 4, and 5 to really get a sense of how many locations are opening each year in each state. And then you can just scroll to the bottom of those charts and they show you the aggregate numbers. So you can see just, how many were open at the start of the year, how many were open at the end of the year. And that doesn't factor in new units that have opened. So you just get a clear picture there of what's actually going on. And yeah, guys, so that's all the questions for today. So hopefully I can rip through a lot more of them in the next AMA next month at the end of February. And yeah, if you have any questions or comments or suggestions on the format, if you want it to be more formal, or if you do like just me kind of riffing off the top of my head, feel free to let me know. And yeah, thanks always for listening.
Thanks for listening to Franchise Empires. We're coming to you soon with actionable insights to take the next step on your franchise journey. So make sure to subscribe on Apple, Spotify, Google, or wherever you listen.